A rally, a solid rally for a second day in a row. The S&P posting its best two-day gain since April 2020. The Dow climbing 800 points to close back above the key 30,000 level. That seems like a big number.
It is.
The Nasdaq leading the way up more than 3.3%. All three indices up more than 5% from the year's lows hit just on Friday. Take a look at Treasury yields down again. The 10-year touching a low of 3.56%. But is this bounce off the bottom for stocks a move that will last? And I think a key thing to answer is, do you think this move in yields, do you think this move in the dollar will last?
It is just so early to talk about a Fed pivot. We had some jobs numbers this morning. They call them the JOLTS. And again, those are the job openings numbers. Maybe a prelude to a payroll number on Friday that begins to give the Fed some relief. But remember, folks, everything we've heard from this Fed is that you're not going to see them, even if they were ready to actually pivot. They're not going to do anything in the short term. So I just call this another one of the most fantastic trading markets of all time. And if you think about what we've had 17 moves of plus or minus 5% or 5.5%. But we've had 9 moves of 9% or more, plus or minus. Again, moves up and down. We've probably had 4 or 5 north of 12 to 13%. So it is a trader's market. There have been some very clearly defined ranges. Technical and chart guys, and certainly our guys, Carter and Chris Verone, have had some great calls here. You've had classic head and shoulders. You've had 200 days been the stop line. You've had oversold conditions where markets bounce. I'm not saying it's that easy. I'm just telling you there's a lot more of this to come.
Guy, at one point last week, I think you said you could walk in and see a 5% face-ripping rally. I mean, we saw that in the past 2 days. Maybe it's a few days off. But still, I mean, this kind of sort of violent reaction to the drawdown, that really illustrates these sort of bear market rallies and how strong they can be.
Yeah, we're all sitting on the desk. Dan said similar. And listen, in our world, though, early is wrong. So we were early. But we talked about it on Tuesday. And one of the things that we pointed out, I think it was Tuesday night, that, look, you know, the VIX had traded up to 34 and change that day. You saw some really crazy intraday moves. And that spoke to what I called bad Greek or negative volatility for you option players at home. And it sort of stood to reason that we were setting up to be able to play the market from the long side, which looked brilliant until obviously Thursday and Friday happened. Now Monday and Tuesday happened. So this is a tough game without question, but I don't think it was out of the realm of possibility because we discussed exactly this last week. The question obviously that you're asking is how much is left, and there might be a little more left without question of the upside. We're still in a very defined downtrend. You know, we've seen the VIX trade down to the mid-20s. Maybe we needed to get there first, but don't be fooled. We talk about it. The most violent rallies take place in bear markets, and I'm pretty convinced we're still in one.
Well, yeah, and Carter was on last night, and he was showing us the lines that he likes to draw, that downtrend that's been in place in the S&P 500 since January 2nd. To Tim's point, all the volatility that we've seen, but they really have been a series of lower highs and lower lows. And if you do just kind of the simple charting there, if you get back to 4,000 in the S&P, that is the 50-day moving average. And if you were to overshoot, that would be an 11% move from Friday's lows, and you overshoot up to the downtrend near the 200-day moving average at 4,200 or so. That gives you a rally that was basically equal to what we saw from the June lows to the August highs there. And listen, could that happen? Of course it could happen. If this jobs number coming up on Friday is just, again, to Tim's point, shows that some of the stuff that the Fed has been doing gives them a little air cover. Then we get to CPI next week. Maybe that's not so hot. Maybe earnings, that when we get into the bank earnings in the next week after that, maybe they're not so bad. Did you see JP Morgan was up nearly 5% today? That's astounding. And JP Morgan did what it needed to do. It filled in the only unfilled gap in that chart going back to November 2020. So my point is we could have a similar sort of move like we saw in June and July into those highs. And then I've been saying this for about a week now. I would not be surprised if the Fed has some data that goes their way that in late October, a week before the midterms, when they have that November 2nd meeting, just before that, we see a trial balloon floated where maybe Fed funds futures have already moved more towards a 50 basis point rather than a 75 at the November 2nd meeing, and maybe they take their foot off the pedal, and maybe that is the thing that allows the market to rally. But I just want to say, no,
bullish, Dan.
I am not short, and I'm listen. I'm short dollar. I'm short yields. I've been long some stocks. I took the QQQ short off last week. My point is, you got to let things breathe. I said it last week. You do not want to press situations where sentiment got so negative at a key technical spot last week. All that being said, I'm telling you, this market did not bottom before we had the recession.
Short-term bullish, but extremely skeptical in terms of the role politics will play in the Fed's trajectory on interest rates. Jeff Mills, I don't know if you buy that. I mean, or just the simple notion that maybe things got so bearish and that there's plenty of short covering to go around here in the past couple of days. And maybe we are sort of just, getting repositioned into what will be a lot of news that could determine what the Fed does.
Yeah, I think sentiment has to be part of it, right? And you see these types of moves in bear markets all the time. This is nothing new. But ultimately, I think it comes down to the labor market and what that means for inflation. I think that's going to be the key. Whether this Fed pivot narrative is legitimate or not, it hinges on that. I don't think it is. Tim mentioned job openings coming down. They're down 1.8 million from the top. The Fed wants to see that. But look at the quit rate. It's still really low. So there is tightness in the labor market that we're going to need to see come out to see any type of wage growth deceleration. That's really what the Fed is going to look for before they're willing to blink. And the last thing I'll say, just relative to trying to parse what's going on here, we're not seeing the momentum spark off of the bottom under the surface. It's like, well, how can you say that after the last 2 days? If you look at the percentage of stocks in the S&P 500 with 2 standard deviation daily advances, so these big moves to the upside, you're only seeing 10, 20% of names doing that. Usually off durable lows, you see 50, 60, 70% of stocks making those sorts of moves. So looking under the surface and trying to see whether that typical momentum spark is there, it's just not yet. So combine the technicals with some of the fundamentals I'm talking about, I still think the bulls have a tough case to make.